Welcome to today's session on tax planning and tax saving investment. My name is CA Shoikat Roy, and today I will be walking you through the facets of income tax planning and investment. Today we have Rahul with me. Rahul is a qualified professional. He is actually leading the team of internal CAs along with me, and he will be there in the chat box to resolve all of your queries. And without further ado, let's dive right into today's topics. Now, in today, we will be learning about who should plan for investment, why should one invest, what are the various investment options available for a person, and how and when to declare those investment to employer, and what if we forget to invest, we forget to declare that investment. And we are going to look at some tidbits of tax savings and some important things that can really rejig the entire concept of income tax return filing. Right. So firstly, we are going to look at who should plan for investment and its declaration. Now, it's a very widely accepted fact that people should invest and save the taxes. However, there are certain conditions wherein a person, having made the investment, do not really require to make the investment, or they are not eligible to take, or rather they are not required to take the benefit of tax saving investment. For example, people who are opting for new tax regime, they are not required to plan for investment, because any which way under the new tax regime, they are not going to get any tax saving deduction. That being said, I'm not saying people who are opting for new tax regime should not plan for investment. Of course, they should invest. However, it will not impact their tax computation because of those investment. Furthermore, any person whose income is no more than 5 lakh rupees, that person are not required to plan for investment, because any which way that person's income they are required to file the taxes, but they are not required to pay any taxes by virtue of Section 89 relief. However, there are certain class of people who should definitely take a note of investment and declaration. Firstly, person whose salary income is more than 5 lakh rupees. Now, if a person whose salary is more than 5 lakh rupees and opting for the old tax regime, they must declare the investment and plan for investment. Why? Because if my income is more than 5 lakh rupees, I am supposed to pay 5% or and 20% of tax on an incremental basis, slab wise manner. So in that case, my objective for that situation would be to reduce my tax burden as much as possible. And for that reason, investment and tax declaration is a must. Person who are opting for old tax regime, as I have said, under the old tax regime, you can take deduction for a lot of expenses and investment. Therefore, it is absolutely imperative that you declare all of your tax saving investment under the old tax regime. Furthermore, any person who have the investment like insurance, home loan, rent paid, rent received, it needs to be declared as well to the employer, because number one, because rent received, if I am receiving a rent, that becomes my income, right? And if I am earning some amount of money in my hand, I am required to pay some taxes on that amount as well. However, if I do not pay taxes on that amount, what happens is at the time of filing the income tax return, I declare all those incomes. And at the end of the day, I have to pay taxes any which way, right? But if I'm paying the taxes at the time of filing the income tax return, what happens is I am supposed to pay a good amount of money as interest because I am defaulting payment of taxes. Because as per the Income Tax Act, if my tax liability is more than 10,000 rupees after considering all the TDS and TCS and everything, then I am supposed to pay advance taxes, right? And if advance tax, rather the tax liability is more than 10,000 rupees, I am supposed to pay advance taxes. Now, if that happens, if I fail to pay advance taxes, then the income tax department, asks for interest because you are not paying the taxes in an advanced manner. Therefore, if you are declaring your additional income along with all the investment and declarations, you can save yourself a certain amount of money in terms of tax interest. Now, what is the ideal deadline? What is the ideal deadline to declare those tax saving investments? Originally, at the beginning of the year, you are supposed to declare that during this year I will be making XYZ amount of investment, right? Or I will be paying XYZ amount of rent. So all of these taken together, the employer, what they do is they compute the taxes, deduct the taxes, and pay it to the government. And at the time of the month of December or January, the employer, what they do is they ask for investment proof. Now, it is a very crucial step for them because at this point of time, the employer works as agent of the government. The government has asked the employers to compute the taxes and deposit the money in the hands of government. Also, they want them to review the documents and make sure appropriate amount of tax has been deducted. Now, if you have declared a certain investment during the year, but if you have not declared the amount or rather submitted the proof, the employers, what they will do is they will think that this amount, even though declared, has not been made as an investment during the year. Therefore, they are going to ignore all the declaration that you have made at the beginning of the year, and they will be deducting, they will be recomputing the taxes, they will be recomputing the income, and they will be deducting taxes. And if certain declarations are completely ignored, in that case, your income will increase, which will affect in your tax being increased as well. Therefore, it is absolutely imperative for you to declare the deductions as well as submit the proof whenever the window is open from your employer's end. Now, let's try to understand why should one invest. First of all, saving the taxes. Yes, the prime objective for us to invest is to save our taxes. There is no denying it. However, there are a couple of secondary objectives as well. First of all, saving for the future. If I am investing in a instrument, say for example PPF. Now PPF, I will be getting whatever amount I am investing, I'll be getting once I attain the retirement age. Therefore, I will be securing my retirement time. Financial planning, yes, I will be most definitely planning my financials. Again, if I'm planning to invest in PPF or ELSS and willing to hold them for a long period of time, at the time of my retirement or any goal in the future, they will give us a better return. For example, I set myself a goal after 3 years or after 5 years, I'll be purchasing a flat for myself. For that, I start making investment. And after 5 years, if my corpus is large enough, I will be able to down payment for the flat that I am looking for. So financial planning is one of the key aspect of investment. Wealth and asset creation, right? So you can create wealth, you can create the asset if you plan to invest. For example, uh, if you are investing in ELSS mutual fund, right? So what mutual funds do is they pool the amount that their investor is betrothing upon them, and they invest the amount in various companies. And if the company, if the business, if the economy is doing well, your investment grows as well. Therefore, there is a wealth creation happening. And finally, one side effect of investment is it can reduce the cash balance available for you, which otherwise you could have made some unwanted expenses. Instead, if you are investing, then chances of those unwanted expenses happening comes to a very lesser extent. Now, let's talk about what are the expenses. What are the expenses that you can claim for tax saving? First and foremost, this is the most talked about expense, that is house rent allowance. Now, if you are staying in a house which is rented, and you are taking that rented apartment or place for your employment purpose, in that case, if your salary has that particular allowance, you can take the house rent allowance exemption. How this works is your salary must have a HRA component embedded in. Now, some of the companies by default give you HRA component. Other companies, let's see, gives you a big bucket of allowances from which you need to allocate certain amount into eligible categories. One of such eligible categories is house rent allowance. So if your salary has a house rent allowance by default built into it, then you don't really have to do anything about it. However, if your salary does not have default house rent allowance embedded in it, in that case you need to shift some money from special allowance or other allowance, whatever name it may be called, and you can shift certain amount in house rent allowance so that you can claim it. Secondly, there is a notion that whatever amount of rent that you are paying, that can be deducted as HRA, which is not true. HRA, the deductibility of HRA, that actually depends upon the city that you are living in, and it does not take into account, or rather, you cannot deduct the entire amount of rent that you are paying as HRA. To get to know about the HRA, there are certain figures we need to take and compare. First and foremost, 40% or 50% of the basic. That depends actually upon the city that you are staying in. Actual HRA that you are receiving, and finally the actual rent paid minus 10% of the basic. Now 40% or 50%, that actually means that if you are staying in a metro city, in that case 50% of the basic will be applicable, otherwise 40%. And metro city in this context means Delhi, Mumbai, Kolkata and Chennai. Any other city for this purpose are not considered for 50%. Now, looking at these numbers, looking at these items, that doesn't really gel with you that how actually it is going to happen, how actually it is going to be computed. Fret not, because we are going to understand this in later part of this presentation. Second allowance that we can talk about is leave travel allowance. Now, leave travel allowance is a lesser known allowance. However, people, it's a very good way to save taxes. Now, basic premise of leave travel allowance is if you are traveling during your employment days, in that case, whatever the travel expenses you incur, some of the travel expenses that you are incurring, that can be allowed as deduction. Now, there are certain criteria for it. If you are meeting those criteria, then most definitely you will be able to claim leave travel allowance. First and foremost, leave travel allowance is allowed twice in a block of 4 calendar years, right? So you can avail leave travel allowance 2 times in a block of 4 calendar years, or rather 2 years in a block of 4 calendar years. The present block has started from calendar year of 2022. So presently we are at the second year of the 4-year block. Now, let's look at the criteria. Firstly, the travel needs to be a place which is within India. Second point, you can travel with you, your dependent, spouse, and your child. All traveling expenses of all these four persons will be allowed as deduction. Thirdly, only to and fro expenses to the place that you are visiting can be taken as deduction. Now, when I say to and fro expenses, I mean to say, let's assume you are presently in employment in Bangalore and your hometown is, let's say, in Delhi, and you are taking a plane from Bangalore to Delhi, and you are taking your spouse and your kids with you. In that case, the flight ticket from Bangalore to Delhi, and whenever your vacation ends from Delhi to Bangalore, these expenses can be deducted. No other expenses are allowed to be deducted. That includes the cab fare, the meal, in case if you are traveling to any other place, the hotel expenses, the cab expenses over there, those expenses are not covered. Only to the place that you are visiting, either by train or flight, those expenses will be deducted. Now, in case if you are traveling by plane, then economy class airfare can be deducted. If you are traveling by train, then AC class fare will be deducted. It includes AC first class, 3 tier, 2 tier, whatever it may be. Now, what other expenses that can be considered for deduction? Firstly, petrol expenses of motor car. Now, uh, lockdown is being lifted up. Lockdown has been lifted up for quite some time now, and we are at present stage we are visiting our offices for our work purposes. 2 days, 3 days, or 5 days, whatever its situation may be, we all are currently visiting our offices for employment purposes. Therefore, the travel has also increased, and in that case, if you are using your own personal car for office visit purpose, there is a good chance you can allocate a certain amount as petrol expenses in your salary, and you can claim that as allowance. Secondly, uh, some of the employers do provide uniform allowance. Now you can purchase clothes, garment, which ideally would be using to visit the office. That expense can be allowed as deduction if your employer permits you to have uniform allowance. And another most popular allowance is food coupon allowance, wherein rupees 50 per meal for maximum 2 meals a day is allowed as deduction. So most of us use any food wallet or specialized food card for this purpose. So if you have that option, you can already take that because it can save you around 2,200 rupees a month. It will, or rather, 2,200 rupees will be deducted from your taxable salary. And if you belong in a 30% slab rate, in that case, around 660 rupees you will be able to save in taxes. So if your employer gives you this option, then most certainly go for it. Right. What other tax saving expenses are there? One of such expense is interest on home loan. Now, people are buying flats or houses. In that case, and to acquire that, they are taking up loans from banks. And whatever amount of interest you are paying, that can be deducted from your total taxable income if it is within a certain limit. Now, first and foremost, the interest component of home loan is deductible under Section 24B. Maximum deduction available for you is 2 lakh rupees a year for self-occupied house property. Now, self-occupied house property in this context means a house property that either you are living in or your parents are living in. Thirdly, the house must be completed if the house is still under construction, because nowadays what happens is the builder start building the house property, and once and they open it for booking, and you go take a look at the flat, choose a flat, make the down payment, and start paying the amount to the builder. Now, if this situation happens, you are not eligible to claim the deduction because the house must be completed and in possession of yours to claim the section 24B interest deductions. And however, there is a caveat to this. For example, if the house is under construction and if you are still paying interest on that house property, you still will be incurring a certain amount of expenses on that house property. So will that interest be for naught? The answer is no. You can still take the benefit of it. However, you can claim the benefit not at one go, but in 5 equal installment after the house is completed. So what happens is, say for example, in financial year 21-22, you booked a house. However, the house is yet to be completed. 22-23, the house is still under construction, but 23-24, the house is completed. Now, 21-22, you have paid, let's assume, 1 lakh rupees of interest. 22-23, another 1 lakh rupees of interest. And total interest that you have paid during these 2 years are 2 lakh rupees. Now, these 2 lakh rupees will be allowed to you over a period of 5 years in 5 equal installments. So every year I will be able to claim 40,000 rupees. So if in the year 23-24 I am paying again 1 lakh rupees, I will be able to claim 1 lakh rupees interest that I have paid for that year, plus 40,000 rupees of interest that I have accumulated over a period of 2 years. So in the year of completion of the house property and me possessing it, I will be able to claim 1,40,000 rupees. However, it must be noted that maximum amount of interest that you can claim is 2 lakh rupees. So whether the current year's interest or current year interest plus previous year's interest, the total amount will not exceed 2 lakh rupees in a single year. Excuse me. Now there are certain questions that arises in people's mind. What if I have bought this house property, I have bought this flat and registered it with my spouse? What will happen? Will both of us be able to claim the interest? To that, answer is yes. If the house property, the flat, is bought in a joint ownership as a joint ownership and the loan is also taken as joint owner, in that case, the amount of interest and the principal will be split between you two evenly, and both of you will be able to claim the interest component as well as the principal component in their respective income tax return. Second question in this context arises are, I stay in a different city than my hometown. I have taken a flat in my hometown. For my employment, I have taken a rented apartment. I am paying rent. But in my hometown, I have taken a flat for which I have taken a home loan as well. And in that flat, my parents are staying. Will I be able to claim HRA and home loan interest together? The answer is yes, you will be able to claim. Nowhere these two sections, the HRA section and the home loan section, these two are not conflicting sections. They are pretty much clear in what they say. If you have taken a home loan, and it is a self-occupied house property paid by yourself or your parents, your dependent parents, in that case, you will be able to take home loan interest component benefit most definitely. And since you are staying in a rented place for your employment purpose, you will also be able to claim HRA benefit. Now, when we are talking about interest on home loan, there is another section which may be useful for you. Now, This section is over and above section 24B that allows us 2 lakh rupees. Under section 80 EEA, I can claim additional 1.5 lakh rupees of interest payment. However, there are certain criteria for it. First of all, the loan should be from a bank. Number two, loan must be sanctioned between 1/4/2019 and 31/3/2022. The stamp duty value for the property should not be more than 45 lakhs, and the loan should be taken to purchase first property of the assessee. Now, people, if those conditions are satisfied for you, then you are eligible to take another 1.5 lakh rupees of deduction. However, it must be noted, first priority will always be given to section 24B, and after claiming 2 lakh rupees under section 24B, if you have paid any additional amount of interest, then it can be claimed under 80 EEA. However, you must meet the following criteria. Let's try to understand this situation with an example. Let's say you are meeting all the criteria for section 80 EEA, and your total interest payment for the year comes to 3,20,000 rupees, right? So out of this 3,20,000 rupees, you will be able to claim 2 lakh rupees under section 24B, and remaining 1.2 lakh rupees you will be able to claim under section 80 EEA. Just because I have mentioned that there are two sections for which you can claim home loan interest, it doesn't mean you can claim a expenditure twice in your income tax return, right? So firstly, utilize section 24B. If it has been utilized fully and still there are certain interest left, then look for conditions under 80 EA. If your condition is matching with conditions laid down under section 80 EA, you can happily take the remaining interest. Otherwise, section 24B is the only recourse for you. Now, there is another section. There used to be another section, that is 80E. However, that was specific for financial year 16-17. And if you are taking interest for section 80E, you cannot take the benefit under section 80EA. Now, what are the investment options under section 80C? Now, this is the most talked about section under which you can save the taxes. Now, under section 80C, first and foremost, we are going to be talking about provident funds. Now, provident funds are of three kinds. Number one, employer provident fund. Number two, public provident fund. And number three, voluntarily provident fund. Now, employer provident fund, it is an amount that is deducted by your employer every month from your salary. For this, you don't require to submit any proof. Second point is PPF, public provident fund. Now, PPF is a provident fund which is run by government and it is operated in every bank. You can just go ahead and approach the bank or post office, whatever it may be, and you can open up a public provident fund account. However, there is a catch to it. You cannot invest more than 1.5 lakh rupees in PPF in a single year. And PPF amount is given to you once you attain the age of retirement. Voluntary PF, again, this is something your employer enables you to do, and there is no such investment criteria for VPF. You can invest any amount you please in VPF. However, the limit will always be limited to 1.5 lakh rupees. Second point is children tuition fees. Now, children's fees, tuition fees are generally deductible from your taxable income. However, only admission fees and actual fees for tuition, these two are deductible. Your child can be attending schools or college or university for that matter. There is no burden on that. However, if you are paying any development fees or donation, they are not allowed to be deducted. Life insurance premium. Now, if you have taken a life insurance policy from an insurer who is approved by IRDI, the insurance regulator in India, in that case, whatever amount you are paying to keep that policy alive can be deducted as under Section 80C. It can be name of yourself, your spouse, your children, and you can claim the full amount in the year of payment. There are certain conditions, or rather there are certain policies which allows you to pay 2 years interest or 3 year interest at one go. In that case, in the year of payment, you can take the full amount. Principal on home loan. Now, we have earlier talked about the interest component of home loan that we can claim under Section 24B or 80EA. Now, we will be talking about principal on home loans. Now, to claim the principal on home loan, firstly, house must be completed, and secondly, the loan must be taken from a recognized banking institute. If you are fulfilling this condition, then principal component can be taken under 80C. However, again there is a catch. Maximum amount that can be claimed is 1.5 lakh rupees. Also, if you have taken a home loan and if you have purchased a home, in that case, certainly you will be paying some sort of registration fees or stamp duties. Those two items are also deductible under 80C. ELSS. Now, ELSS, these are equity linked savings scheme. Now, ELSS is a kind of mutual fund which specializes in tax saving. ELSS actually has a very small tax lock-in period of 3 years as compared to other tax saving options under 80C. Now, you can invest in SIPs or a lump sum amount, and whatever amount you are investing, it can create a slew of wealth option as well as tax option for you. However, it is to be noted, ELSS actually depends on condition of the market. If the market is working well, then ELSS can give you a wonderful return. However, in a longer period of time, it has been seen that ELSS gives you much better return as compared to other tax saving options. Furthermore, ELSS, whatever amount you are getting out of at the time of its redemption or at the time of selling it off after the lock-in period, that amount also comes with a little bit of tax benefit. So ELSS, since these are equity oriented mutual fund, up to gains up to 1 lakh rupees is not taxed. However, if the gain amount is more than 1 lakh rupees, in that case you need to pay taxes at the rate of 10%. Next option under 80C is your tax saver FD. Now, tax saver FD is actually FD that gives you a return and return of around 6-7% a year. Whatever interest that you are earning, that becomes taxable in your hand, and there is a minimum lock-in period of 5 years. What can be the other tax saving opportunities under 80C? Firstly, SSY is the Sukanya Samriddhi Yojana. So if you have a girl child, then till she reaches maturity, you can invest the amount, and it has a good amount of return, and it is targeted towards girl child. So it's a very well thought out initiative taken by the government. National Savings Certificate, again, it's a very safe tax saving opportunity for you. And finally, Post Office Deposit Scheme, again, a very safe tax saving opportunity for you. Now, what other ways you can invest under 80C? Now, pension plan is also a good tax saving opportunity for you. It not only ensures you have a good inflow of income at your twilight years, also it has a tax saving benefit attached to it at the time of you making the investment. employees contribution to NPS. Now NPS has a threefold tax saving option. Firstly, you can invest in NPS, and whatever amount you are investing will straightly go towards contribution towards ATC. Excuse me. However, if you are investing in NPS along with other investment instrument, then NPS has a wonderful tax saving applicability built into it. If you have exhausted all the other tax saving avenues and you choose to invest in NPS, then by the virtue of investing in NPS, you will be able to reduce another 50,000 rupees over and above 1,50,000 rupees under ATC. And finally, employer contribution in NPS, or rather NPS contribution through your employer. What happens is, if you choose to invest in NPS, you can do it in two ways. Number one, you can invest on your own. Number two, you can invest through your employer as well. Now, if you are going through the investment through your employer, what happens is maximum amount that you can invest is 10% of your salary, your basic salary, right? So if your basic salary is, let's say, 10 lakh rupees, in that case, 1 lakh rupees you can invest through your employer in NPS, and that 1 lakh rupees will be deducted from your taxable income. However, a point must be noted over here that any amount that you are contributing towards NPS, if it is more than 7.5 lakh rupees a year, then the excess amount, which is more than 7.5 lakh rupees, will be taxed in your hand. So, to summarize it, maximum amount that you can invest in NPS without bearing any tax repercussion is 7.5 lakh rupees. Now, we have seen all the tax saving investment. But these tax saving investment and expenses are applicable for the older tax regime. In new tax regime, it does not really impact. Out of all the instruments that we have seen for saving the taxes, only one, that is NPS through your employer, is eligible under the new tax regime. But is it any good? Is the new tax regime any good? We have seen from our numbers that very less people actually are opting for new tax regime. Why? Because even though the tax slabs are smaller and the tax rate is smaller as well, there is no way you can reduce your taxable earning under the new tax regime. However, if you think intelligently, if you are investing intelligently, in that case, you can take benefit of older tax regime and you can save a lot of taxes. Further, if you are choosing to invest in NPS, you can save a further amount. So let's try to look how these numbers actually factor in, right? So at the beginning of this session, I have already talked about one component, that is HRA. Now we are going to look how the HRA and all the other investment together can create a beneficial situation for you, right? So let's assume that you have a salary of 10 lakh rupees, right? And you are staying in Bangalore. Out of that, that salary structure of that 10 lakh rupees is 5 lakh rupees is your basic, 2 lakh is your HRA, and other allowances is 3 lakh rupees. The rent that you are paying in Bangalore is 20,000 rupees a month, that is 2,40,000 rupees. So let's try to look how the income computation actually happens. Under the new tax regime, there is no deduction whatsoever. So 10 lakh rupees, straight away 10 lakh rupees will be your total salary. However, under the old tax regime, 10 lakh rupees will be your gross salary. From there, we will be able to reduce 1,90,000 rupees of HRA. Now, Here lies the question. I have paid a rent of 2,40,000 rupees, but how am I getting HRA deduction of only 1,90,000 rupees? Remember that we have discussed that it is a myth that entire amount of rent that you are paying can be deducted as HRA. It's a complete myth. To get the actual amount of HRA deduction, you need to see three amounts. Number one, 40% of your basic, since Bangalore is not one of the metro cities as per Income Tax Act. Number two, 40% of the basic. Sorry. Number two is actual HRA component that is there in my salary. And number three, rent paid minus 10% of my basic. Now, if you do the math, actual amount of HRA is 2 lakh rupees, 40% of the basic is also 2 lakh rupees, but rent paid minus 10% of the basic becomes 1,90,000 rupees. That is why we are going to take 1,90,000 rupees. From there, we will be reducing standard deduction. Everyone gets that. And we will be able to reduce any professional tax or tax on employment for that matter. After doing all this, my total salary comes to 7,57,600 rupees. Now, again, that person, the person about whom we are talking about, is a very prudent person. So he has made a lot of investment. So in LIC, he has made an investment of 50,000 rupees, ELS is 25,000, SSY 30,000 rupees, PF again, employer is taking a deduction, and medical insurance. Again, as I said, that person is a very prudent person. All those things together, my total taxable salary is coming to 6,19,000 rupees under the old tax regime. However, and under the new tax regime, it is still 10 lakh rupees because I cannot take deduction of any such nature. Now, if we look, my tax slab under the new tax regime and the old tax regime works a little differently. Up to 2,50,000 rupees, the tax rate is nil under both the regimes, so there is no need to pay any taxes. From 2,50,000 to 5 lakh rupees, the rate of tax is 5% under both the regimes, so 12,500 rupees will be chargeable under both the regimes. From 5 lakh to 7,50,000 rupees, the rate of tax is 10%. So under the new tax regime, the increase is 2,50,000 rupees, so 10% is 25,000 rupees. And 7,50,000 to 10 lakh rupees, the rate of tax is 15%. Again, increment of 2,50,000 rupees, 15% rate of taxes, that will give us 37,500 rupees. Under the old tax regime, however, beyond 5 lakh rupees, the rate of tax is 10%. However, beyond 5 lakh rupees, my taxable income is only 1,19,000 rupees, right? And on 1,19,000 rupees, I am supposed to pay 20% tax, which is coming to 23,800 rupees. Now, if we add all of them together, under the new tax regime, my tax liability is coming to 75,000 rupees. And we need to add the cess, health and education cess, at the rate of 4%, which will be 3,000 rupees. And all in all, tax payable will be 78,000 rupees. However, under the old tax regime, my total income tax will be 36,300 rupees. 4% will be the education cess, and the total tax liability would be 37,750 rupees. So, if you structure your salary, if you plan your investment, you will be able to save under old tax regime around 40,000 rupees, which is no mean feat. Now, how we can save the tax outgo by another 15,000 rupees? Now, as I have mentioned, if you are investing in NPS, you can take benefit of 80CCD 1B, right? Because under 80CCD 1B, you will be able to take another 50,000 rupees of deduction. In this scenario, your LIC is 50,000 rupees, ELSS is 25,000 rupees, SSY, Sukanya Samriddhi Yojana, is 30,000 rupees, and your EPF is 21,000 rupees, right? So along with that, if I invest another 50,000 rupees in NPS, I'll be able to take that 50,000 rupees into my tax computation and will be able to save 15,600 rupees, which is inclusive of cess. Now, what are the other options under or rather beyond ATC? Going beyond ATC, that gives us Section 80D. Again, because of the corona pandemic, it has been brought into sharper focus that having a health insurance is a very good plan. In case neither you nor your parents are senior citizen, then you can take 25,000 rupees for each. So for you, your dependent spouse and kids, 25,000 rupees. For your dependent parents, another 25,000 rupees. Now, if you are a normal person, but your parents are senior citizen, in that case, just because they are senior citizen, the limit will be increased to 50,000 rupees instead of 25,000 rupees, right? And if your senior citizen parents are not covered under any medical insurance, in that case, medical expenditure can be taken instead of medical insurance. What are other deduction available? Firstly, 80DD and 80DDB. When 80DD is for a dependent who is differently abled, right? So if you are maintaining a differently abled dependent person, depending on their disability limit, maximum amount that can be claimed for their medical treatment is 75,000 rupees if disability limit is more than 40% but lesser than 80%. In case they are severely disabled, that is more than 80%, in that case 1,25,000 rupees of medical expenses can be claimed. If you are or any dependent are diagnosed with specific diseases, in that case you can take 40,000 rupees or 1 lakh rupees. Now these specific diseases are quite severe. Parkinson's disease, motor neuron diseases, AIDS, cancer, those things are covered under that. When you yourself, the assessee, is a differently abled person, in that case, you can take medical expenses up to 75,000 rupees or 1,25,000 rupees, depending on the disability limit. Further, if you have taken a education loan, then the entire amount of interest without any ceiling limit can be claimed as deduction. And if you are donating to any charitable cause, in that case, maximum 50% of the amount of donation can be taken as deduction. Now, let's talk about investment proof submission. Now, you need to declare the regime, you need to declare the investment proof at the very beginning of the year, right? Based on that declaration, your tax computation, your tax withhold is computed. However, you must be submitting the proofs whenever the submission window is open. By any chance, if you miss the submission window, then you have left with only one option. That is, you can declare all these things, all that investment and everything at the time of filing the income tax return. However, since you are missing the deadline, your employer will be deducting a huge amount of taxes, right? And if all the deductions are considered, then you will be able to take the deduction at the time of its filing. Now, we are at the end of our session, and we will be opening the floor for question and answer. If you have any question, please drop the question in the chat box and we will try our best to answer that. Thank you. Well, Gagana, so card, if we are talking about that, is allowance, and that thing needs to be talked with your employer. That will not be coming under ATC or ATD, but it will be coming under a different section altogether. It will be coming under section 10. Right. So I believe we have reached at the end of our session. Thanks for being a wonderful audience. I hope you have learned something and you can take away this understanding and apply. Thank you for joining with us. Bye bye.